Good day and welcome to another episode of Skytale Insights. I will be your host today, Ben Hernandez, CEO and Managing Director of Skytale Group, and I will actually be doing it solo today. So this will be my first time being with you alone. Very excited about that. And the reason for that is what we'll be covering is as we look forward from an investment banking firm perspective into 2026, what is the market telling us? And if you're thinking about even entertaining the idea of selling in 26 or beyond, what should you as an owner be thinking about? Now, in order to do that, as I was thinking through, where do we start? I think we are going to do macro level down. So let's go back to 2023. In 2023, I would consider this right now to be where we bottomed out from an M&A perspective in recent years. If you go back to that time, close your eyes, imagine where you were in 2023. We had a very interesting market of, coming from a really, pretty nice boom in healthcare and consumer subsectors that we play in. We all of a sudden were hit with an inflationary environment with rate hikes. And we were hit with, are we not in a recession? And if we're not, are we going into one? So that put a lot of nervousness in the market, had a bit of a, down year, M&A wise anyway, that year. And then you fast forward to 2024. 2024's theme was, and it wasn't a surprise, but we were in a presidential election year. And what happens there is, generally some of financial sponsors, private equity groups, what they'll do is they'll sit on the sideline a little bit, or at least deals move a little bit slower. And the reasoning behind this is uncertainty. When you're in a presidential election year, it happens fairly frequently. So we weren't necessarily surprised. So 24 was another, fairly average year. So then we get into this year, 2025. We're nearing the end of 25. But at the beginning of the year, we were very bullish. I think, just the entire market was bullish. We thought it was going to be gangbusters. And there was political uncertainty at that point in time. Think back to February or March, I think it was, when we started hearing and implementing the implementation of tariffs. And what was that going to do? So then if you're a buyer or if you're running a business, you're starting to think, what does that mean for me? What does that mean for my industry? What does that mean for my subsector? Am I going to be affected by this? Are prices going to go up on, anything I'm selling, what have you? So that caused a bit of, a shift in the market during that point in the year. And what we're seeing, Q3, Q4, we're seeing a little bit of an uptick, which is nice. So that's where we are today. I'll say, in 2025, what we're seeing is the valuation does remain strong. So that's a very positive thing. The value's remaining very strong, but the number of deals that are getting done, small uptick, but it hasn't been as strong, I would say, as the value's holding. Now, when you look into why, the why behind that is the lower middle to middle market deals are not moving as quickly. So the deals that are getting done are more upper middle to large cap markets, and the valuations there are doing very, very well. So then you ask, why do we think that the lower middle to middle market number of deals aren't getting done? And I think a lot of it has to do with Q1, Q2. When you have this uncertainty, I think a lot of the especially smaller sponsors tend to sit on the sidelines a little bit more because of that uncertainty. And I think a lot of that has to do with, whether it's the teams are not bigger, they don't have the, certain access to the larger markets. You just have to kind of have that wait and see approach. So that's, I think, the story of 2025. So predictions for 2026, from a Skytale point of view, I think I'll start by saying 2026, we expect to be very positive to positive. And the reasons for that are many. I think number one, private equity continues to have quite a bit of dry powder. Dry powder is essentially money sitting on the sidelines that needs to be invested for your LPs and for your fund. So, for that, you ask why. Well, in 2021, we had a record level of, number one, capital raising that year, and then number two, record levels of dry powder that were ready to be invested. And we just went over 23 to 25. So if you think 21 being a record year for that, that means that there's still quite a bit left to be deployed, needing to be deployed. I also think that as of the recording today, we've had two 25 bip rate cuts that have certainly helped from a rate perspective. And we were maybe expecting a third this year. I don't know if we'll get a third this year or not, but certainly as we look at 26, we expect continued easing on the rate side of things. So, we're probably going to be looking at probably 3.5 of interest when it's all said and done next year. So that really opens up, the lending markets. It opens up from a cost of capital perspective. If I'm investing capital into you, it gives me a little bit more flexibility, which I think increases confidence. And certainly from a seller perspective, that's all positive. So I think 2026 I would characterize as a year of kind of selective confidence, where what we'll see in the sectors and subsectors that we play in, investors are going to reward businesses that are run very well. So from a macroeconomic perspective, I think I'll summarize it by saying very positive to positive for 2026. So if you're thinking of selling, think a pretty good market to do that in. If that's the macro view, the next thing that we have to take a look at, or you as a seller, a potential seller should look at, is from a healthcare consumer M&A perspective, in the lower middle to middle market, what does that look like specifically for me? And same concept, I think, as overall 2026. We think these spaces are going to be extremely attractive to investors, especially a lot of the spaces that we play in, especially within healthcare. They tend to be recession-resistant spaces. They tend to be spaces that do well in times of uncertainty and certainly do very well in times of certainty and in times of, low inflation environments and so forth. So we're very bullish on our end on 2026 for the spaces that we play in. And then beyond that, I think high quality assets are going to continue to be very, very well rewarded. And then even beyond that, I would say one thing that we look at, and I talked to some other, investment banks in the middle market, really some larger banks, and they're seeing this as well. We have a backlog of clients that are ready to go to market, and from a timing perspective, trying to determine when is the right time, but, already signed, already ready to go. And we're seeing a lot of other banks that actually have this. So what does that tell you? What that tells me is that there's going to be a nice influx into the market of high quality assets that are ready to transact in 2026. And I think buyers are ready to transact in 2026. So I think that's what we would expect from a very specific healthcare and consumer space, lower middle market perspective. So now we're moving more into, how about me? Let's get a little bit more individual. If I'm a business owner, what am I thinking? How should I be thinking about things if I'm thinking of transacting in 2026 or really ever? And I would start by first figure out your why. Why would you consider transacting? I would just sit down and really get clear, even before you start thinking of evaluation or anything along those lines, is what is your why? And just some things to maybe help you along that we see on a pretty frequent basis. I'll give you three that we see fairly frequently. Number one is maybe it's timeline that you had to retire. That's a pretty frequent one. Someone calls us and they'll say, hey, Ben, I'm 50 years old. I thought I'd be done around 55, 60 max. Is now a good time? Should I wait until I'm 55? And if timeline is a thing, then that's something for you to think about. And then some knowledge to go with that would be, just know that typically in the spaces where we play, 3 to 5 years is around about how long you'll be asked to stay. And the reason for that is you're probably a key part of the business. We deal ultimately in services. And so you have a lot of loyalty there, whether they be your patients or your customers. So that would be one example. Another example is, hey, look, this is my blood, sweat, and tears. I want to de-risk. I want to, take chips off the table, or I have a dollar amount in mind. Those are all very good reasons. And what I would think about in this case, maybe some tips is if you're thinking of de-risking or there's a certain value, is really understand how your business might look like today if you're to go to market. And if that's the right number for you, then great. That's checked off. And then it's completely up to you as to when you want to go. If there's still work to be done, then great. You at least know exactly what you need to do to get there. And, if you're thinking de-risking and what have you, just know, we've seen it before. You just never know when something's going to hit. I would say life happens, markets change, health changes. You just never know. So that's another reason why some folks think about it is just really monetizing your life's work. And then finally, the last one, and this one's actually pretty fun, is you want to continue to grow, and you've grown the business sometimes even bigger than you and your vision even thought you would get to. That's a pretty exciting one. And folks, let us know. I feel like I'm on a rocket ship, and if we just had the right partner to add fuel to this, we could really take off. And those are fun because what that does, sometimes we've sold platforms, and what a platform is a private equity, typically buyer, looking for that initial investment. And your organization is large enough and sophisticated enough to be that initial investment, to be that platform of whatever new space or sector or subsector that they're entering into. Or if you have a decent enough business, a nice enough business, we see things like regional leadership, regional platforms in cases where, the buyer might not be in your specific area and space, and you're going to, be part of that leadership team. So that's another reason why some folks think about. But before you even get into the details, I would absolutely start with the why. Great. So now you have your why. The next question that I would ask myself as a seller is, how do buyers even evaluate my business? Okay, that's very important to know exactly what they're looking for. Could arm you and help you pretty well as you think about going through this journey. And you could grade yourself as well before you even decide to go on this journey. So I think, number one, I often get calls and they're like, well, all they care about is EBITDA. That's very incomplete. And we're about to get into why, which gets, I think pretty fun. This is the meat of the conversation here. So, if you're taking notes, this might be the part to take notes. I think from the very top, I would absolutely suggest that you do something like a pitch book, something like that. You can call any firms like us, you can have it evaluated however it is that you want, frankly. But what this allows you to do is it allows someone to let you know, a third party to let you know, this is, if you were to go to market, what it might look like, what value might look like. And I would do this before talking to any buyer. And we can get into why here in a little bit. But really the point for now is, how do they evaluate you? So those are some tips before you ever even get started. Now, as far as what do they look like, what do they look at rather, I'd start with qualitative factors. That's a big one. And what does that mean? Under qualitative factors, I put together a few that we see that if you differentiate yourself can be very positive. Number one would be reputation and brand strength. So think of this as your digital footprint, your reviews, how many followers do I have, depending, of course, on the spaces that you play in. But this really allows you to differentiate yourself from a reputational perspective, and how is your brand doing in the market? And from a reviews perspective, what does your customer think of you and your business? Along those same lines, I would say, what do your customers think about you? So for this one, I would look at my customer or patient retention percentage. That's a big one. This one's a big one because it gets into operations as well as, the clinical or the front of the house, if you will. I, as your customer, I'm letting you know how I'm treated when I enter your space, how you're treating me when I'm in there from a, chair bedside manner perspective, if you will. And when I'm leaving, am I being escorted out correctly and nicely? And are you keeping in touch with me to where I'm coming back? That's a pretty big one that I would, focus on, maybe, take a look at and see where you are. I'd say, service offering mix is another big one. Diversification is a good thing. So you want to be able to show any potential investor, this is how I treat my customer, my patient, from a holistic perspective. And this is how they all, play with each other. Because just think about the fact that buyers don't like risk. We heard it at the macro level that I just gave is anytime you introduce unknowns, anytime you introduce risk, it's not a good thing, which is, I think, pretty logical. I think another one that's certainly coming up in a lot of these spaces, talent acquisition and training. If you have this, I would absolutely highlight it. If you don't, I would start figuring out, how do I acquire talent? How do I train? How do I retain? Any of those things that you're able to differentiate yourself on is significant and something buyers look at. I would also look at what's my infrastructure of the business from a systems and processes perspective. So think SOPs here. Do I have repeatable systems? Do I have a recipe? Do I have a secret sauce, a certain way of doing things? This is especially important if you have multi-locations. And the reason being, you can't be at 8 locations on your own as a founder owner. So you have to figure out a way to inject, if you will, your DNA into the organization. And how do you do that? You do that with repeatable processes, repeatable procedures that the team adheres to and, potentially even improves. Now you're really showing I'm something that you can replicate. And then I'd say management depth and strength is an interesting one. If you have a significant team, that will always be important. And clinical compliance, regulatory, just know that we're seeing increased scrutiny in these areas. So, especially if it's a subsector that's increasingly in the news, just make sure that you have that tightened up. Again, this goes to the risk perspective. Now, let's move on to the quantitative. So from a quantitative perspective, the most obvious one I think everyone knows about is historical financial performance and momentum. So if you think about this, your buyers are going to be buying future cash flows. So anything you can do to de-risk that, I don't know what future cash flows are going to be, is going to give you some nice credit. So what does that mean? It means that the best tools that we have is we're going to look at your historical performance. How are you performing historically leading into today? And then when I put those forecasts in front of you, buyer, are you going to believe them? And that's really something that you should have some really tight financials, really tight way of modeling. If you do this already, if you're forecasting every year and you're able to show a buyer, I already do this, by the way, and here's what my forecasts look like year over year, and then forecast to actual, anything along those lines, going to give them tremendous comfort. But that's something that they look at. Of course, profitability metrics and margin is going to be very important. Are you running your organization professionally and efficiently? And here I would just say, try to find metrics. We have them. Try to find metrics to compare yourself to your space and figure out, where do I do well and where do I have opportunity? And it's always opportunity. It's not, where am I not doing well? So where do I have opportunity to improve? I'd say provider diversification and productivity is a big one. Again, this goes back to risk. If you as a founder owner are the only producer, that's going to be very risky, and they're going to price it that way. Whereas if you're able to bring on additional team members that can add to revenue, now you're figuring out, going back to the processes thing, now you're figuring out, hey, I have a system. I have a secret sauce. I can show you this. I can do this. I can bring on another, team member. I can train them. I can hold on to them. That opens up just an entirely different type of business from a buyer perspective. And then I would say turnover is another big one to look at, certainly at the revenue producing positions. This speaks really to consistency with teams. It also can speak into culture. If you have, turnover that's drastically above or even above market, figure out why. It's probably your culture. It might be pay, something along those lines. But just know, again, buyers dislike volatility. So anything you can do to get rid of that would be great. And then I'll finish off the quantitative by pointing out same-store growth, organic same-store growth. This is so important. I can't tell you how many times we've talked to people and they'll say, well, Ben, I'm still growing. Well, if you're growing because you're adding locations, but your legacy locations aren't growing, that's a problem. So just know that organic same-store growth is something you need to keep track of. So if you're multi-site, be able to really know how each of your locations is doing, not just from a top-line revenue perspective, from an expense perspective, from a team perspective. They're going to look at all of those. And if you're able to have this really nice mix of mature locations that are holding steady and growing, locations that are still ramping but growing nicely, and new locations, then you're able to really see, okay, I kind of know what the new locations could or should turn into because they've done this before, and they're able to stabilize that and continue that growth. That's a very valuable business. I'd say the next big one that buyers look at is, what are growth opportunities? So if you're a multi-site, what's your growth strategy? Is it de novo? Is it acquisition? How much white space is there? Another one would be actionable pipeline. If you're a multi-site group, again, you're able to show, here's how I got to where I am, but then also I have a pipeline already, and this is how I'm grading this pipeline right now. And by the way, you know this is a not surefire thing, but you know this is somewhat going to work because I've already done this before. I have a model in place to identify where should I go next? How am I going to do when I go there? So here what we're looking for, if you think about growth opportunities, is credibility. There's a big difference between ideas and execution. And if you're an organization that has ideas but can execute and act on those ideas, you'll really differentiate yourself that way. And then finally, if I'm kind of grading my business and how my buyers look at me, this one is a bit tricky. It's market factors. There's sometimes not much you can do about that, but I would say, look at how is consumer confidence and spending in my area or my subsector? How does that look? Is this is my subsector growing or is it holding flat? And if it is, be able to answer, how are you able to grow in lieu of that? So, regulatory and oversight in certain areas also. California is a lot more strict than Florida, for example, in healthcare. And you need to be able to know that, and you need to be able to foresee what a buyer's going to think about that. And then depending on the environment that you're in, how competitive is your environment and what's your secret sauce to differentiate yourself? So if you're in a secondary market, a potential advantage might be that if you're a business that's doing really well and have a stronghold on it, we typically see some really, really nice margins there. So that's going to be a big plus. If you're in a market like Miami in aesthetics, okay, I'm assuming you're in a very competitive environment. How are you differentiating yourself? How are you going to continue competing? And some of the things that we just went over are things that you can put forward to really show a buyer. So if you're a seller thinking about getting into a buyer's mind, those are some things that I would think about my business. And how would you grade yourself if you were a buyer? Okay. Let's say you like what you're seeing, you've done your why, you like the market economics. So now you understand what your business may look like to a buyer. The next step I would take if I'm a potential seller is, what does this process even look like? And on that note, I would say selling a business should not be a fast or quick event. It should be structured, it should be well thought out, and there should be a process to it. Think about the fact that you are selling your life's work. You wouldn't even sell your house on the whim. So to sell the company on the whim, I've seen it, I'll never understand it. So what I would do is know that it takes about 7 to 9 months for a proper process, okay? And how do we break that down? I'm not going to get too much into the details, always happy to expand on any of this. But the point of this is simply to put, from a frame of mind perspective, how long a proper process should take. So first, if you are to hire a very good lawyer, I would absolutely do that. I would hire an investment bank such as ourselves, but anyone I think is going to add a lot of value, and we'll get into that in a little bit. Potentially a CPA, some sort of tax advisor, and certainly know from an asset management perspective what you're after is going to look like. And if you're early enough, I would actually suggest calling a wealth advisor or an asset manager earlier rather than later, because there are some things that they can do before you even get the first offer from a value perspective that we find to be very helpful. But if you decide to go, you have your team assembled, the first couple of months is what I call the preparation phase. And all this is a buyer is going to ask you for so much information. They're going to look into all of your closets and drawers. So what we're doing here is we're taking all of your information, putting it into what's called a virtual data room, and then also building out the marketing materials. So really this is, how do you best represent your business? Who are you? How long have you been around? Information about your market, about your leadership team, about your business historically, but also the future of it, to really position the asset very, very nicely. And then finally, you're building out a buyer list. So highly recommend that you never go with simply the first buyer, the second buyer who calls you. When we take folks to market, depending on the business size, the range is 60 to 120 buyers. And if you think about that, it's not too different from selling a house. And that's where we increase the value a lot. It's not anything we do that's magic. It's simply, wouldn't you want 100 people looking at your house versus one seeing that offer and taking it? And imagine a world where you didn't really know the value of your house. You didn't have a Zillow, anything like that. This is really kind of creating a market and letting the market speak as to what they value your business at. And, I can get into stats such as, sellers that go with us that already have an LOI in place. We've increased on average that LOI to the one that they actually end up signing about 53%, a little bit over 53%. This is the same business. It's simply that you're looking at a lot of buyers, so they know they're competing with one another. But then even so, we get bids from buyers that are, 30% different, something like that. So I would absolutely suggest this. The next phase of the business is when you have all that ready, you go live. And, this takes another 3 months or so, and I'm not going to get into the details of it. But essentially, early on when we're reaching out to, let's just say 80 buyers, we're protecting your time here. We're answering questions on your behalf. This is typical. Buyers know that. And then the goal is to get some sort of range as to what they're thinking about your business. And the ones that are attractive get to meet you. So that typically involves a dinner, a site visit, what we call management presentations, which is effectively updating folks on the last few months of your business, how you're performing. And it also, this is very important, allows you to meet your potential partner after this closes. So that's another big one that you should also be diligencing them. That's very important. Just know that your business is highly sought after, very attractive. You should be diligencing. And then coming out of those, you get official offers, or what is an LOI, letter of intent. And if you like one, you sign it. And that's another 90 days. So if you think about the 7 to 9 months and you're like, oh, this is so long, just know 90 days of that, regardless, you're going to go through, probably longer because you'll have to get the data together, which is pretty typical. And there it's the buyer doing a lot of the diligence. So that's very, very high level what a sales process looks like. I just didn't want to get into all the nuances of it. But I would absolutely, before going through a process, suggest going through the things we discussed before that and ensuring you have clean data, you can articulate your business, because it'll pay off when you go through a process such as this one. So I think now, we've taken you from the beginning macro level. What does the market look like overall? What does the market look like for my subsectors? How's a buyer going to look at me? Great. If I'm interested, what does a deal look like? To summarize, I'd say maybe some actions and risk mitigation to take is, right after listening to this, what I would do is I'd go assess my business with some of the points that we outlined as to how buyers are going to look at you, how buyers are going to evaluate you. Even if you don't sell, or even if you never want to sell, this is going to add value to your business, because what it should do, just think about that. These points buyers are congratulating you on or beating you up on, it's because that's a business that you build. So if you build a business that's highly valuable, then that should mean increased margin, increased cash flow, less turnover, whatever that may look like for you. And so these are, regardless of where you are in this cycle, things that I would go through those, check your business, see where you can maybe tweak it a little bit, give yourself a pat on the back if your business is running very well on some of those points, as you should. I'd say another thing to keep in mind is don't have a business that is too dependent on you. Another way of saying this is, if you want to build a utopian business, build a business that can survive you, the founder or owner. You're building a business that has, multiple revenue producing folks, multiple providers. It'll be a business that has a significant team. It'll be a business that has processes, procedures, all those checklist items that we talked about. So if it's too dependent on you, it'll reflect in the valuation of your company. And if it's too dependent on you, the buyer will want you to stick around longer, which that may not be a bad thing, the sticking around longer, but just know that to be the case. I'd say building a team around you that's quality. So a good team, a professional team, buyers are going to want to look at as you continue to grow, as you continue to diversify beyond yourself as a founder owner. What does that team look like? Do you know how to hire? Do you know how to retain? All of those things that we talked about earlier. Talent is a big, big point right now in the market. If you can figure that out, you built a pretty good business. I'd say this one's very important to me, because I see this so much. Sell on your timeline. You shouldn't have a buyer or anyone calling you saying, oh, it's time to sell. If you don't sell today, XYZ will happen. Sell on your timeline. Study the market. How is it going? How is the market for your specific sector and subsector? Is it still good? Check in with folks maybe once a year if you're not interested in selling this year, just to get a gauge on, educating yourself on what might your business look like. But sell on your timeline. Don't feel pressured. You've worked so hard. Think of all the blood, sweat, and tears that have gone into your business, and it deserves to be stewarded along correctly. So I think that's a big one, is really decide on your timeline. To tie it back, go back to that why. And when you're ready, be ready and get a really, really great outcome for your business. And then, finally, I can't stress this enough, build a quality team around you. Get that CPA, that tax advisor, wealth advisor, M&A attorney. I should have said that earlier. Be sure they're an M&A attorney, and an investment bank. Just know that when the buyers that you're talking to, when they sell, they also are going to be building that same team that I just mentioned. So clearly there's a reasoning for it. Build a really quality team, because whatever it is that you spend on that, you'll get it tenfold, whether it's in value, whether it's in deal structure, whether it's the right partner, or a combination of all three. So those are some immediate actions, risk mitigation to take and keep in mind. And that brings us to a wrap. As we thought about, going over 25, looking into 26, and especially from an investment banking perspective, if you're thinking of selling or wanting to know how might folks look at your business, always happy to answer questions should you have any. Would love to chat. My email is ben.hernandez@skytalegroup.com. You can also go to our website, skytalegroup.com, and submit an email that way. Would love to chat, would love to be in touch. Always enjoy talking about all of these subjects that we went over today. We hope you got something out of it. Wishing you a great end of 2025 and a very beautiful and fruitful 2026. We hope you enjoy this episode, And if you're not already subscribed, would love if you subscribe to Skytale Insights. Thank you, and until next time.